Hello everyone, this is Professor Kent. Today's recording is to take up the homework for chapter 6, and then in this chapter we're going to review chapter 5 too, which is related to the CCA. Now in this question I got two big problems, and that this will cover the whole chapter 6. So what the question is asking: calculate the current year's net income. So we are going to be calculating something called net income. And when we have a net income, this is my accounting income. Accounting income is producing the GAAP principle. So what we're going to do is we start with an accounting income. Either we add something or subtract something, or we do, if it's allowed, then we don't do anything. So the first thing we're going to start off with accounting income for tax purposes. Accounting income before taxes. Accounting income before income tax. And the number that we are starting off with, 950,000. That's what the income we're starting off with. We're gonna do additions. We're gonna do additions, and we're gonna do deductions. So these are the two things that we are going to be doing. So then when you have it, the first thing we're going to do is we want to know what should we do with this. So it says during the year the company spent $5,200 for what? Landscaping. So this is the other information. So they spent $5,200 for landscaping cost for its head office ground. For the accounting purpose, this was treated as a capital expenditure but was not an amortized during the year. So what we are going to do is we wanted to know what should we do with it. So it'll be a deduction because landscaping cost is deducted. So landscaping cost is deducted the year the landscaping happened. So we have a landscaping cost, and it will be $5,200. It will be a deduction. Then going to the next one, we have other expenses. So we have other expenses. So what are the other expenses? These are the other expenses, and there we want to know what should we do with it. So if it's other expenses are a deduction, if it was a deduction, we needed to add back if it's not allowed. So the first one is discount amortization. So that will be added back. So if you are learning about it, sometimes it's easy to sometimes it's easy to make a note what you have to add or what type of expenses is you have to add back that is not allowed under the income tax. So sorry, my pen is back, so it's not. So first one is we call the discounting. So we're gonna do discount amortization. That will be added back. So we're going to add back the discount amortization. Then what we're doing is we're going to go to our next one. Next one is interest on the deficient corporate income tax installment. So what we do is we have to pay interest on what? We're paying an interest on sometimes it's the system gives me a problem. I'm just going to write it on here with my hand. So I hope you are able to discount on amortization. We're going to add the 500. We're going to add the 1700. That is what it's an interest. So this is an interest on income tax penalty. So interest on income tax penalty. Oh, there it is. So we're going to be adding the 1700. Going further, we dealt with that, we dealt with this. So what we have is we have something called reserves for future inventory. So it went down in a price. So 1 year you deducted, the other year you'll be adding it. In this case, so reserve from accounts receivable is allowed, but reserves from inventory decline is not among the allowable reserves. So if this was related to the accounts receivable, it would have been allowed, but since it's related to my inventory, we have to add back the reserve 30/92. What is it? It's an inventory reserve. So if it was for accounts receivable, it would have been allowed for 1 year, deduct from 1 year, add back the next year. So inventory reserve, we needed to add it back. Going further, we have something called interest paid on the bond issue. That is an okay expense. We don't need to worry about it. Amortization expense is not allowed because we're allowed a CCA. So we're going to add back your amortization expense. In this case, my amortization expense is $36,500. I'm going to add it, but I'm allowed a CCA. So that will be my deduction. So amortization expense, we have dealt with that. So I dealt with that, we dealt with that. Now when we think of advertising, cost of advertising, distributor only in Jamaica. So what we call this, we call it a foreign advertising. If it's a foreign advertising, that is fully deductible as long it is not directed to Canadian crowds, but in this case it's directed to Jamaica, so it's a foreign, it is allowed, so we don't need to do anything, it's allowed deduction. Charitable donations, I needed to add back. We're going to get a credit for it. It's not a deduction, we get a credit. So charitable donation, I'm going to add the 19,100. Same thing with your so then charitable donation, we dealt with it, so we know that we already dealt with it. Now what we have is we have something called hockey. Next one we have is the hockey team, $3,200. So what we paid is we sponsored a hockey. It's a promotional. If it's a promotional, it is a deductible. If it's a deductible, they already deducted, we don't need to do anything. Now going further, cost of advertising, circular 50% has been 50% has been distributed. So if it's 50% has been distributed, what we needed to do is multiply by the 50%, which is 7,500. So what we need to do is we needed to add back the 7,500 because that is my prepaid advertising. So that is a prepaid advertising, and we expense it the following whenever we use that advertising. Now going further, we have is other income. We have other income and losses that relates to this. So what do we do with it? We needed to know what we're going to do with it. Either we add or we do what we do is we subtract. So in this case, we have income or losses. So it says damages paid for breach of contract. Damages paid for breach of contract, it is fully deductible. That if it's fully deductible, we do nothing. So if it's fully deductible, we do nothing. And my next one is we have theft. Theft happens. Losses of this type results from it's a normal cost, so it's fully deductible. So this is also fully deductible. If it's a deductible, we do not do nothing. And this is cost of appraisal fees. So what do we do with the cost of appraisal fees? Now we needed to add it because we are going to deduct it where at the time we dispose this property. So we needed to add back and we needed to do an appraisal. It is an appraisal fee. We needed to add it back. Now we have a CCA. They already calculated. They didn't ask us to calculate it. But the next example, we will be calculating it. 57,500. So what did we calculate? We calculated net income for tax. net income. So this is the net income, and then this is my net income. How we're gonna do is you're gonna add and subtract. You're gonna get a number. The number that I got was 105,700. So that will be the net income they asked us to calculate it. Now the next question is a bigger question too. Of course, if it's a bigger question, there's a lot more going on in the question. So if there's a lot more going on, of course we needed to kind of work out the what's happening with it. Now it says calculate the minimum net income, ignore any GST and PST. So when you do that, the first thing you're going to do is you're going to start with my net income. So net income, the question told us for the taxation year ending December 30, 2024, they have a net income of 565. So this is the number that we are starting off with, 565. So now again, similar to what we did in the other question, and this question is bigger because I see there's a classes of CCA. So we are going to have a deduction, and we're going to show you how to calculate the CCA too. We showed you in chapter 5, but we're going to show you more questions on a CCA. So first thing is when you do it, we have the first thing is we have a current income tax. Current income tax is we calculate using the percentage that we thought the company is in, but we're not. Current income tax is not what we pay to the CRA. So what we're gonna do is we're gonna add back the current income tax, and in this case the current income tax is 210,000. We're gonna be adding it back. My next what we have is we have something called future tax benefit. Future tax benefit is because we have we produce our income using my tax GAAP principle. However, in the income tax does not recognize the GAAP principle, and then what we have is we call as something called permanent difference and temporary difference that you learned it in your intermediate class, chapter 18. So we have a deduction for my future tax benefit. So there will be a deduction for future tax benefit. Future tax benefits, we are going to we're going to pay less taxes in the future, and it is a deduction for us. In this case, it is a deduction of 23,000. It will be my deduction. So now we have an interest expense is an allowed per. We have a discount amortization that is included in it. If it's included in there, what I needed to do is I needed to add back the discount or a premium amortization. So you could have a premium or you could have a discount. If you have premium, you take it out. If you have a discount, you add it back. How much that is your 3,500. Going further, we have an interest on income tax. It's your fault. It's deductible for accounting purpose, but it's not deductible for income tax purpose. So we have an interest on my income tax, and we add back. How much did we add back? 12,500. What we have is we have an installment on reserve on future inventory decline. So we have a reserve. This reserve relates to what? It relates to inventory that is not allowed. If it's not allowed, that we have to add it back, and it's an inventory reserve. Going further, we have amortization expense. I needed to add back because that is not allowed. The allowed is my CCA. So amortization expense, I needed to add back the amortization. Charitable donations, what do I need to do? I needed to add back because the charitable donation, what does that do? It gives us the credit. So charitable donations, I will be adding it back. Charitable donations. So what we have next is we're sponsoring a soccer team. It's a promotional. If it's a promotional, it is allowed. So we don't need to do anything on it. So then we have loss from employee theft. which is $5,200. It's a normal expense. We don't need to do anything. Loss on a, now this one is loss on a sale of vehicle, which is 36,200. In this case, I am connecting that to my where am I going? No, loss on a sale of a vehicle. So let's look at it where my vehicles are. I see that's a class 8. These two are connected, and what we're going to do is we're going to have an ad, and we could have a we have a loss on sale of vehicle. It is how much is it? In this case, they told us 92,100 was the carrying value, and we sold it for 56,500. There's no loss that is allowed, and I'm gonna be adding back the 36,200. That's the loss that came up with it. So we already dealt with that. So we dealt with that. So let's go further, and we have appraisal fee. Appraisal fee will be allowed when we sell the property or this building, and I'm going to add back the appraisal fee. At this point, it is not deductible. Appraisal will be deducted at the time we sell it. Building to be sold, to be sold. Now going further, we needed to calculate my CCA. We have a different classes of a CCA. If we have different classes, what we needed to do is we needed to calculate according to what is happening. So let's look at each one and see what we are going to do with my my class 10, and the class 10 we're going to be looking at your allowable terminal loss on a class 10. So we added back the accounting loss, but we're going to be working with the terminal loss. So let's look at the CCA and see if we can calculate it. My first class, let's do that. I'm going to do it here, and I'm going to add back all the CCA. I'm going to deduct the CCA, whatever the number we're going to calculate it. So we have a class 1. What we do is we started off with class 1. What we did is we started off with opening balance. The opening balance they told us, and this question was opening balance. We started off with 325,236. That's what we started off with. And what happens in this case, class 1, and we have something called, we had an appraised. Class 1 is your building. We have appraised, that is capitalized. So I'm gonna add the $2,600. So that is not fully deductible, but we write off slowly. So what we did is we appraised the building. If you appraise the building, it's going to be addition. It will be to be sold. So we're going to be selling this building in the near future. We wanted to know if it went up in a price or down in a price. That is my appraisal fee. It is not a deduction, but we can write it off as a CCA. So if I add these two numbers, that will be my CCA base, and I add them, and it is 38327, and the class 1 is in a 4% rate. So I multiply by the 4%, and what do I get? I got a CCA that we are allowed 13,113. So that's my first CCA that I will be adding it to my other CCA. So this is my first one. Let's go to my next one, and I have class number 8, which is class number 8 is what is for what we have is class number 8. They told us we started off with, which is furniture and fixture. So we're relating this to my class A. We have something called opening balance, and my opening balance that we started off with 226,964. That's what we started off with. And then what we did is we purchased and we sold. So they said the company purchased it. If it's a purchase, it will be called an addition, and my addition will be 262,000. And what we did is we have sold. They said the cost was 275, and the fair market value of the asset was 189, and were traded for 189. So what happened is that the cost was 275, and then proceeds was 189. We take a lesser of both, and that will be a deduction, 189,000. So we take less the proceeds of disposition. We take the lesser amount is 189. And what we have is we have accelerated, which will be a null here, and then what we come up with your CCA base. So you add and subtract, we get 299,964, and the class A we come up with a 20% tax bracket. That will give me my CCA is my 20%, and that will be your 59963, and then my CCA base for the next one will be, to start off with, my next year's base will be 239,971. In this case, I am going to circle my CCA because I will be needing that. Now in the class 10, what we have is we also have a terminal loss. So what we have is we have a terminal loss, and what happens is that we have class 10. So class 10 reflects to this one. We have these two goes together. Let's do class 10. My class 10, we have something called opening balance, which was 87,468. That's what we started off with. They told us that we sold something. They told us that in class 10, what happens is that we told that in the accounting record, the carrying value was this, and the vehicle was sold and proceeds with the lease vehicle. The sale proceed was 56,500. The amount of each vehicle being less than the capital cost. They did not tell us the capital cost, but they don't need to tell us it's not given to us. If it's not given to us, we take a lesser of capital cost or proceeds. In this case, my proceeds was 56,500. It's not given, so we take this as a 0, but I'm sure there is. So the lesser of the both is 56,500. I minus it, and what do I get? We call it, we have an ending balance. In this case, my ending balance in my class 10 was 30,968. So it is my positive balance, and then I needed to, in order to make this 0, what I have to do is I have to negative this balance. If it's a negative, we call it terminal loss. If I have to add it, we're going to recapture. That's what we're going to. So what we're going to do is we are going to take the terminal loss. Let's look at my terminal loss. If it's a terminal loss, I deduct the terminal loss. It is 30,968. And now what I needed to do is I needed to add both CCAs. My both CCA on the classes will be, I take 13,113, 59,963. I add both numbers. In this case, I add both number, whatever the number is, I should come up with a number. In this case, it is 670. So 83,000. And did I miss something? What did I miss? I think I missed some of the CCA. Seems like it. Yes, that's I didn't see it. That I see there is class 13, and what we have is we have also class 14, which I didn't do. So let's go back and finish the other one. So let's look at my class 13. So this is my class 13. When you have a class 13, what did they say? That we have a lease and we are allowed one renewal. So the life of the lease was 10 years, and we are allowed one renewal. So the the amortization is on a straight line basis. The amortization will be the threes or the CCA that we are allowed will be over the 14 years, and that will be my 2600. So that's the CCA on class 13. We dealt with that, we dealt with that, we dealt with that. Now we are dealing with computer equipment, and that is my class number 14. In this case, it will be class will be your what are they saying here? So we have prior to 2024, all the computer equipment was leased. In 2024, computer equipment and system software were purchased for $20,000. So this will go under my computer equipment and system software will be class number 50. Under the class 50, we're allowed is the cost was $20,000. We're allowed 100%, but we have to take the half year rule on that, and that will be my 10,000. That will be my CCA that we are allowed. Now we also have goodwill on number 3, and that goodwill will come into my class number 14.1. We started with the opening balance. In this case, opening balance, we started with the 0, and we purchased a goodwill. My purchase goodwill will be 55,000, and there is no ACC investment adjustment, so there will be 0. Then what we have is this will give me my CCA base. That will be my 55,000, and the class 14.1 is your 5%. I multiply by 5%. What do I get? I get a CCA of 2750. So now I'm ready to add everything one more time. 13,113, 59,963, 2,600, and we have $10,000, and then we have 27,050 if I needed to add everything, and you should get a number of 88,456, and that will be the CCA that I'm allowed, 88,456. And once you add and subtract, what you're going to get is I add all my additions, and you deduct all your deduct the deductions. In this case, if I added 332,150, I will be adding it, and if I add up all my deductions, that will be your 142,424. So that's my deduction. And what did I get? I get my net income, and that net income will be my 754,726. So that's what we started. That will be my deduction. Thank you so much for listening to me. I will be recording chapter 7 soon. Thank you so much, and don't forget to subscribe to my channel. Take care and bye for now.